Okay, everyone, this is John Thomas, the Mad Hedge Fund Trader. Just checking in early for my webinar, Profiting from the Chaos. If you can hear me, type your first name and the city where you're from, and I'll say hello. Okay, there is Jonathan from San Juan, Puerto Rico, I assume it is. There's Jan from Portland, Oregon. There's Bill from another Portland, Maine. Jesse from Los Angeles, California. We have Richard from LA. We have Michael from Fresno. Boy, I bet it's cooking over there. We have Richard again from San Diego. We have Thomas from Scotland. And I bet it's pouring rain over there, but great place to do some hiking. We have Simone from Basel, Switzerland. Hello, and look forward to seeing you again for lunch someday in Paris. Passing on Paris this year, going to go straight to the Alps. Zermatt last year we fried from the heat when we were in Europe. This time I'm heading straight for cooler temperatures. Okay, we can still have more people coming in. We have Marie from Las Vegas. Thanks for coming to the lunch last month. Most enjoyed meeting you. We have Robert from Kansas City, Missouri. And we have Yoshio from Tokyo, Japan. We have Richard from Hong Kong. Bet things have been pretty busy over there. Okay. Let's see how we doing on time, and gonna have to use my clock because the other one, my old-fashioned clock, is out of date. Okay, well anyway, let's get the show on the road. Hello, this is John Thomas, the Mad Hedge Fund Trader. Today's webinar is entitled Profiting from the Chaos, and we have had plenty of chaos recently, and I bet we're going to have a lot more before it all ends. Moving forward, why listen to John Thomas? Well, I have 50 years of experience in the global financial markets, soon to be 51 years, 10 years as the economist correspondent in Tokyo, Japan, and later the White House, 10 years running the international equity division at Morgan Stanley, a little time out as a Marine Corps combat pilot in Desert Storm, 10 years running the first international dedicated hedge fund, 5 years fracking for natural gas in Texas, and now 12 years publishing the Diary of a Mad Hedge Fund Trader. I was counting up my content the other day, and I have published more than 10,000 research pieces over the last 10 years. No wonder my fingers are being worn down to the nub. Suffice it to say, there isn't anything that I haven't written about at least 10 times in the last 12 years. I do have a pretty deep database of information to go back on, to going back to previous recessions, wars, bull markets, bear markets, and so on. You're invited today because you receive every morning, hot off the presses, the Mad Hedge Hot Tips, the 5 most important things that happened today and what to do about them. And I have to tell you, I get up at 5 in the morning to do this. I scan 1,000 headlines, pull out the 5 most important ones, send it on to you, and I actually love doing it. And it is one of our most popular services. And since you've been reading me every day now for months at least, it's time for you to find out who I really am. I come from a very humble origin, growing up in Los Angeles when it was still mostly farming country. Growing up as the oldest of 7 children, I lived the all-American childhood playing Little League Baseball and becoming an Eagle Scout and hiking in the Sierras and so on. There wasn't much to do in rural California in the old days, so I took a job as a paper boy. This is one of the first papers I delivered in 1963, the Kennedy assassination. Just a matter of time before I found the stock pages. I want to know what all those funny little numbers were for. Eventually, I bought IBM for $20 and sold it for $30, and suddenly found a far better way to make money than delivering newspapers on a bicycle at 5 in the morning. Notice the constancy of working at 5 in the morning. By the time I was 16, I earned enough money to fly to Europe. By the age of 17, I'd visited more than 50 countries and could speak 4 languages enough to get a date. When you're 17, that's all that's important in the world. That's me hitchhiking somewhere in southern France. This is hunting in the Owens Valley in the old days. I'm at UCLA. I majored in math and DNA research. There were about 8 people in the world at the time doing DNA research. That landed me a job at the nuclear test site in Nevada, which was the sought after job of the day. Their yield didn't meet interest paid on bonds, but millions of people killed in a nuclear attack. I didn't see much of a future in that, so I got out of the nuclear business, and the government sent me to Southeast Asia for a few years of intelligence mission where I learned to fly an airplane and also jump out of an airplane without having to land it. That's my graduation diploma from UCLA, and I also managed to pick up a Mensa membership for smart people. As the war wound down, I became a foreign correspondent for The Economist magazine in London. When they learned I had a math degree, they suddenly got excited and switched me over to covering the Asian economy and the stock market. Ta-da! We're now in the stock market age 24, I think it was. Of course, you visited a lot of interesting places, met a lot of interesting people. Working for the government. I ended up with a drawer full of medals, which just sits there and rusts year in, year out, but that's the way it is. As a foreign correspondent, I covered China during the Cultural Revolution, was the first American reporter to visit North Korea since the Korean War, and covered the rest of the continent on the way to all the way out to India. This is a World War II bomb on Saipan. We used to set fire to them and run like hell. Pretty boring on Saturday nights. That was about the only thing you could do. And at that time, there were still just bodies everywhere left over from the war. I figured out very quickly you didn't have to be that smart to make money in the stock market. So I got into the industry, joining Morgan Stanley. After 10 years there, I started my own hedge fund, but not before I got the crap beat out of me at the All Japan Karate Championships in Tokyo. If you think it's tough fighting with a broken wrist with a national champion, try it sometime. I rapidly became the top performing hedge fund manager of the 1990s, eventually bringing in a 1,000% return in a decade. Got my SEC registration, launched a hedge fund, which became the fastest growing at that time. Then the money really started to pour in. It's an understatement to say that when your income goes from the thousands to the tens of millions, it really has a big impact on your lifestyle. All of a sudden, private planes, marlin fishing off the coast of Mexico, and collecting vintage cars become affordable. So I sold my hedge fund in 2000, retired to go into the oil and gas industry. After making a killing there, I missed the stock market and started the Diary of a Mad Hedge Fund Trader back in 2008. Since then, we have averaged an annual return from our trade alerts of 33.83%. I now spend my days pursuing my first love, finding winning trade alerts. But now I do it from my 3 mansions in San Francisco, Lake Tahoe, and Zermatt, Switzerland, where I'm headed off to shortly. I've quit turning millionaires into billionaires. There's far more satisfaction leveling the playing field for the average guy like you and teaching them how to trade. If I can take a $50,000 account and turn it into $500,000, that is more job satisfaction than I could ever get anywhere else. However, every silver lining has a cloud. This is a page out of my tax return. Shows $10.5 million in trading profits short term, $3.87 million in taxes owed. Yikes. I fall down on my knees and thank God I can afford to pay these taxes, and it has no effect on my lifestyle. In the little free time I have left, I pursue my other love, flying vintage aircraft on weekends. If you see an old airplane, flying loops over San Francisco or London these days, it's probably me. That's a 1932 de Havilland Tiger Moth, 1938 Boeing Stearman. That's a 1952 Chipmunk. So I do get around. The oldest logbook entry I have is flying a plane built in 1928, made of Irish linen and Norwegian spruce. The ultimate luxury is to give to those who need it, and you can afford it. As a Marine Corps veteran, I volunteer for grief counseling for widows and orphans, and I'm a major donor to wounded warriors. When the wildfires hit California, I visited the main evacuation centers and handed out over $10,000 worth of Target gift cards. That is the new currency of the day, a Target gift card, and believe me, people really needed it. These up in the upper right, you can see one of the many houses I visited that completely burned down to the ground up in Napa and Sonoma Valleys. So this is what the smart money is doing right now. We're keeping positions small, focusing on the highest quality growth stocks with the best long-term earnings outlook. Don't bother with value stocks. You'll end up with dead money forever. We're hedging out downside risk with options and bear ETFs, buying gold and silver on dips for a return of a weak dollar, and pouring into the major QE beneficiaries on dips, and those would be the big technology stocks, maybe the top 10 or so. And I'll go through which stocks those are in a few minutes. The global economy is in a tailspin. If the Chinese trade war continues to the max, a global recession is a sure thing. Big chunks of small U.S. retailing and manufacturing will go under, and I'm talking about millions of companies. The trade war is spilling into Europe, slowing economies further there. The big Chinese yuan devaluation is offsetting some of the costs of the tariffs, not all of it, and that is going to continue. The world is turning to negative interest rates, telling us that the worst is yet to come. When Germany has a negative 21 basis point yield on their 10-year bonds, you know there's trouble. A no-deal Brexit acceleration throws more fat on the fire. It would be worse for the European economy and therefore the worse for the rest of us. All of the above has triggered a collapse in global interest rates, which is truly mind-boggling. If you're wondering why I'm so happy in the previous picture, it's because I was flying a P-51 Mustang. That's a World War II fighter, kind of a cross between a jet plane and a conventional plane. Stocks, we're seeing a pause in the party that is about to start. The trade wars are now weighing heavily on stocks. The longer it lasts, the more damage it causes, and the Chinese are in no hurry to help Donald Trump get reelected. July will bring a round of earnings downgrades and disappointments. No trade deal and no Fed rate cuts could take the markets down at least 10% from here to new 2019 lows. Any trust threats put a cloud over the FANGs like Facebook, Apple, Netflix, and Google, even though they have no real basis in law. However, the prospect of sharp interest rate cuts is putting a high floor under stock prices. And I see someone just bought the subscription at the end. I don't know how you got to the link, but thank you very much for the part. And I'll see you. Goodbye. Have a great day. No, I want to carry on here. With interest rates approaching zero, there's no place else to go but cash. Bottom line, flat to down 10% for the next 3 to 6 months. And then new highs propelled by ultra low interest rates and a China trade deal hitting all at the same time. That will create an upside turbocharger for all risk assets, especially stocks. Hang on to this letter. I'm going to tell you exactly when that's going to happen. This time it's different. The return of quantitative easing is hugely positive for stocks. The Fed announcement of no more rate hikes in 2019 sent stock markets to all-time highs. So is moving up the balance sheet unwind end from September to March. That effectively injects 2.7 trillion of cash into the economy and is the equivalent of 2 interest rate cuts. When the world goes from QT to QE overnight, you go risk on. China Trade World Settlement will pour the gasoline on this trade whenever it comes. So here's a bunch of charts, and I'm going to put the signals sent out by our proprietary trading algorithm, which I'll describe later. Suffice to say, it's fantastically accurate, great with market timing, and great in overlaying a discipline on everything you do. Right now, we're looking at, we had a buy signal here at the end of 2018. We got a sell at the end of April. That turned out to be a good sell. We got a nice little 5% or 7% correction. I think this rally here also fails and we go to new lows. After that, we go to new highs. My 2020 target for the stock market is 3,200 for the S&P 500. NASDAQ also, same sort of pattern. Major buy here at the beginning of 2017. Got out in the summer last year, got back in again in the December meltdown, and we took profits a month ago and are waiting for a final sell-off this summer to get back in. Eventually, we do get back to all-time high of 9,000 in the NASDAQ. So if you can buy it down here at 7,000 in the summers, run it up to 9,000 by early next year, that is one heck of a trade. You'll take that all day long. And remember, the single stocks that we recommend, they'll go up double that rate. So they'll go up maybe 40% or 50% in that secondary rally. Russell 2000, we only play from the short side. That's because small stocks fall faster than large stocks in a bear market. We got two nice sells this year, and we're looking to sell the next rally. And we use this as a hedge against some of our other long-term positions. Microsoft, major favorite here. We see that going to 200 in the next couple of years. We got all the way up to 140 today. Again, you can see three buys here, here, and here over the last 2 years. And we expect more to come. You basically want to keep buying every single Microsoft dip all the way up to $200. Apple, same deal. They're the #1 risk target in a China trade war. They will therefore be the #1 beneficiary of any trade settlement. So again, buy Apple on the dips. Amazon, similar story. At one point, we were up 40% from the December lows, and there's been a lot of antitrust saber rattling about this one. Suffice to say, if you broke up Amazon in individual pieces, it would be worth twice what it is now. So any breakup of the company would make money. Eventually, Amazon will break itself up, probably in 5 years, because it will get too big to manage, and they'll get a free $1 trillion for their effort. PayPal, notice that we've done no trade alerts in banks for several years. The reason is we think the banking business is going out of business, at least the conventional type, being replaced by fintech. You're getting essentially zero performance out of big traditional banks and enormous performance out of fintech stars. PayPal is one of them, Square is another. Keep buying this one on the dips. NVIDIA, highly cyclical stock, also a big trade war victim. Something like 50% of all their sales go to China. Again, another China piece play. And it's very interesting. We got a triple bottom down there. If we make any more visits down to 130, I'd be a buyer. Salesforce, also massive cloud play. Small hit here on a $20 billion company they took over. That always costs money, but long term, they're dominating the cloud. You want to basically get into every good cloud play you can find. Boeing, another special situation. It's just a matter of time before the 737 MAX gets recertified. When that happens, expect the stock to rally $100 from here. We've been telling people to buy the stock on dips and also sell short, naked, deep out of the money puts, just so you can get some income over the summer while nothing else is going on. Walt Disney, 50% of all large summer blockbuster movies this summer are coming from Disney. They're approaching a near monopoly. I saw one of them the other day, Aladdin. Not as good as the original Robin Williams animated film, but the kids didn't know that, and they all want to go see it a third, fourth, or fifth time. So that's their core business. You can expect more princesses and more Star Wars movies coming out in the future. Bonds is saying the recession is already here, with the U.S. 10-year yield at 2.06%, headed to 133, and then eventually zero. Collapsing global economies are sending a huge flight to safety bid to bonds. Yields have fallen nearly 1.19% since September from 3.25. The huge move has taken place despite a Chinese boycott of the new issue market, which historically has bought 50% of all U.S. government issues. German bond yields down to -21, JGBs down to -11. Global free money puts a high floor under all asset classes, but won't spur them to new all-time highs. We're very active in the TLT, the Treasury ETF, usually do about 2 round trips a month. And you can see what we've been doing here: buy, sell, buy, sell, buy, sell. Usually we were playing from the short side all the way up to here, and then we step back from the market expecting some sort of breakout to the upside, and that's exactly what we got. A massive move up, and we're still waiting to go back into the market. Eventually, if we get yields to zero or close to it, or 133 takes the TLT to $150, a zero interest rate takes it to 200 easily. Here's your yield. We got a low of 2.05 last week, and looks like we're pressing that now. We look again, 133 is our immediate downside target on Treasury bond yields. Foreign currencies, rapidly falling U.S. rates is killing the U.S. dollar, finally pulling it back from a year-and-a-half bull market. Suddenly, decline of rates has cut the knees out from under the dollar, and what's happening is our interest rates are falling faster than European or Japanese or German rates. This is easy to do when the other rates are all negative. They really can't fall anymore. Therefore, sudden falls in our rates really knock the wind out of the dollar. Japanese yen has taken off. Brexit is crushing the British pound. Chinese yuan is being weakened as an offset to the U.S. tariffs. Bitcoin, we've seen a major rally this year on a flight to safety bid. 99% of that buying is coming from China because they have no other place to go, and they're fleeing the yuan. US dollar basket, that was our top right there a couple weeks ago. I'd be selling every rally from here on at the very least. Look to visit the 200-day moving average in the UUP, which is down about 5% from here. Bitcoin, yeah, 120% rally. How about that? Suddenly, people want something speculative to play with. And again, this is all about the Chinese looking for non-yuan protection. Energy recession fears are ramping up. Oil plunges 20% on sudden global recession fears prompted by the China trade war. U.S. production soars to 12.3 million barrels a day right now. It's on its way to 17 million barrels a day in 2024, and that's up from 5 million barrels a day in 2005. So the United States has essentially added a Saudi Arabia's worth of production in less than 20 years. That is having an enormous impact on oil prices and keeping them low. This is why oil stocks have been terrible performers for the last couple of years. Oil's had every geopolitical reason to rise, such as blowing up tankers in the Straits of Hormuz. You know, in the old days, that would have caused a $50 spike in the price of oil. Today, it causes a $2 spike, which it then gives up by the end of the trading day. And the bottom line here is that recession trumps war. Recession fears are far more important than any military risk to the supply of oil. That means $42 a barrel is in the cards. Long-term energy demand completely collapses, and prices fall to $10 a barrel as global transportation goes all electric. We did buy at the end of 2018, got an rally, got out of it right at the top. And again, these are all algorithm derived buy and sell points. And we expect to see 42 from here. So here's a little rallyette you can sell into right now. Here is the 20-year view. And you can really see this as sort of a downtrend in oil prices for the very, very long term. We hit a peak of $150 here in 2008. Then we got the financial crash, another peak here in 2011, right around $125 a barrel. And then the peak this time was only high 70s on its way to new lows. So avoid energy plays, oil plays, all of that stuff. Precious metals is the ultimate hedge. Also makes a nice Christmas present. That's a picture of me shopping, Christmas shopping in the Istanbul gold market. I do tend to get around a lot. Gold will break to new highs as investors look for a risk-off flight to safety hedges sometime this summer. Central banks have become the principal buyers of gold in 2019. They picked up some 264 metric tons last year and are buying even more this year. China and Russia are dominating purchases in order to avoid the US dollar and trade sanctions. Distrust of current US economic and monetary policy is the incentive. Bitcoin is stealing gold's thunder, sucking in global speculative activity. Let's see, just let me make a note here. Bottom line, buy every dip in gold and precious metals. Here is the GDX ETF, the gold miners ETF. We got out of it at the market top. This is a 7-year chart, and gold was in a bear market really for 5 years. Got this sharp rally, which we got into and then got out of. We're now buying it again for another upside breakout. Eventually, we see gold going to a new all-time high, and that could happen as early as next year. Barrick Gold, again, one of the major miners just bought another gold company and changed the ticker symbol. We see a major breakout coming in this stock too. There's another alternative investment, what I call an asset class of one, and that is Tesla. It's where the future lies. Tesla's total cumulative production will hit 900,000 cars this year. Battery costs have dropped by 80% in the last 10 years and will fall by another 80% over the next 10 years. There's a second factory under construction in Shanghai, China. There's a new Model Y coming out, a small SUV next year. US electric cars have risen from 0% 10 years ago to 4% of the market today. That soars to 100% in 20 years. Tesla is already outselling all premium car brands in the US combined, including Mercedes, BMW, Audi, and Jaguar, and they have a 10-year head start on the technology. Many countries and US states have banned the internal combustion engine by 2030 or 2040. Tesla will become the world's largest car company within a decade, causing the shares to rise tenfold or more. It is the next trillion-dollar company. Here is a 3-year chart. You can see we originally bought it at $16.50 after the IPO bust. After that, it rose to $3.92. We made a fortune, so do our followers. In fact, pretty much all of our followers who bought Tesla stock were able to buy a car, buy the Tesla with their profits. We got down here to 180, almost the same bottom that we saw 3 years ago, put in a major buy, and we see the stock going from an all-time high from here. This is my newest Model X. That is the fully tricked out Model X with ludicrous mode. And by the way, if you are going to drive from 0 to 60 in 2.9 seconds, you better carry air sick bags in your car seats or you may not like the result. This is my first Tesla. I've owned 3 of them. This one was totaled by a drunk driver on Christmas Eve who piled right into the back of me, completely wrote the car off. It does show you some of the cool safety features like the honeycomb in the wheel wells. Here's the 1,000-pound, 1,100-pound battery pack right here underneath the back seat, and it really is the safest car in the world. I was just able to walk away from this one. I gained financial independence for life, and so can you. All of this can be yours. Discover how to make thousands of dollars a year in extra income. Go from a complete beginner to a seasoned pro in weeks. Learn how to quit your day job and trade for a living full time. Trade from anywhere, anytime. And this is me trading off the coast of Africa. All you need is a broadband connection. You can do anything. And by the way, you can't see in the picture that this is 120 degrees and the wind is coming off the Sahara Desert. We were dying. Supplement your retirement income with the satisfaction of booking winning trades by the hundreds, and that is what we do here. The harsh truth is, why you really need my help, majority of individual traders lose money. They lack the correct training and discipline to succeed. Most broker research suffers from grievous conflicts of interest, usually just trying to shove stock out the door. Wall Street is about moving money from the uneducated to the educated. The easy solution to that is to become one of the educated. Fidelity did a 20-year study and learned that their top performing investors were dead people. Yes, dead people don't sell. That's a crucial skill to have in a 10-year bull market. That's next to the original Pinocchio, where they come from in northern Italy. You need a real pro to guide you through the market maze. The market is not monolithic, and 95% of it can be completely ignored. There are a few great sectors and a lot of awful ones. You can earn a 10-time return on the great ones, but get wiped out by the losers. Let a 50-year veteran like me steer you to safe waters. Sit next to me and let me guide your hand on every winning trade. This is our market timing index, my secret weapon. This is our proprietary artificial intelligence-driven algorithm that analyzes 30 different economic, technical, and momentum-driven indicators all day long. Why do you need an algorithm? Well, why use a toolbox missing its most important tool? Algorithms become so dominant in the market, you should never trade without one. It does the work of a seasoned 100-man research department in seconds. It runs real time and optimizes returns with the addition of every new data point far faster than any human can. Don't go to a gunfight with a knife. If you are trading against algos alone, you will lose. Algorithms provide you with a defined systematic trading discipline that will enhance your trading profits. And today the algorithm was reading 39. When it gets up to 80, that's an extreme short. When it gets down to 20, that's an extreme buy. And when it's stuck in the middle between 39 and 60, you do nothing. And this updates several times a day, and we send it to our subscribers several times a day for updates. And I'm not the only one using algorithms. Some 80 to 90% of all current trading activity is algorithm driven. And when I was walking on the waterfront in Miami last year, I just so happened to come across this boat. Guess what it's called? It's called Algorithm. You can bet somebody made some serious money trading algos there. Just to show you, we plotted buy and sell signals over time. And this shows you how much volatility you get in the algorithm year to year. Several times a year, we get extreme buys down here, extreme sells, and you can do a lot of round trips every year, and over time, this makes you a ton of money. Just to show you how well it's done for us over the last 3 years, the S&P 500 gained 59.44%. We gained 113.77% with our trade alerts. That is double the performance of the SPYs with much less volatility. Notice that we're basically going up all the time without these giant heartbreaking drawdowns. Bill was a struggling tobacco farmer in Virginia who wanted to supplement his fading agricultural income. After making $3.4 million with the mad hedge fund trader, he still farms, but now he's growing grapes in Napa Valley for the high-end wineries, and he's debt-free. Philip was tired of working in the boom and bust of the oil and gas industry in Texas. After doubling his money every year for several years, he now earns a generous living as a full-time trader. Philip now trades whenever and wherever he wants and doesn't carry a year-round sunburn like he used to do when he was working in the oil industry. And he said he never lost any money on a John Thomas trade. Jackie was an Australian hospital administrator who turned $50,000 into $2 million with the help of John Thomas and became a major player in technology stocks. She retired in her 50s and now spends her time cruising around the world. She sent me this picture from the Queen Mary Mid-Atlantic. So what do we do about all this? Stocks, you want to buy the big dips. Bonds, you want to buy dips also. Commodities, you want to buy dips coming out of the summer pullbacks. Energy, also buy only the major dips for a trading rally. Currencies, sell the US dollar. Precious metals, buy the dips. So if you're not up 32.9% in the past 12 months as I am, you are reading the wrong newsletter or following the wrong trade mentoring service. This is our trailing 1-year return. We're at an all-time high, and notice that we're always moving from the lower left to the upper right, trying to keep to a minimum these huge pullbacks. And by the way, the horrific sell-off we got in December only amounted to this dip for us right here. We tend to stop out of losing positions very quickly. And if you think I was lucky last year, this is our 9-year return. And again, 34.12% for the last 9.5 years. Again, always moving from the lower left to the upper right. You do this kind of trade performance, there are certain things you get to do like nobody else can, such as ride the owner suite from on the Queen Mary from New York to Southampton, England. When you get to England, you can then take the Orient Express to Venice. And it's kind of nice to be able to avoid traffic jams by taking your personal helicopter everywhere you go. The very long view, and this is where the really big money will be made for the next 10 years. The 2000s and the 2010s were the hard decades for making money. The 2020s and the 2030s will be the easy ones, as a global demographic wave brings on a new golden age. 85 million millennials will become the big spenders over the next 15 years, while 80 million baby boomers, a drag on the economy, fade from the scene. That will create an economic boom that will last another decade starting in 2021. We just have to pay the small price of recession sometime between now and 2021. Up 20 times in 18 years. You think I'm making this stuff up? No, that is exactly what the stock market did from 1982 to 2000. 18 years, up 20 times. Replay that kind of move, and this is what you get. We started from the 2009 bottom. We've made it up to 24,000. Assuming we go up 20 times from the 2009 bottom, that takes us to 120,000 by 2027. So looking at the longer term chart, you are here right now. We've had one fourfold increase from 2009 to now. We'll get another fourfold increase from now going into the late 2020s, early 2030s. Why is that possible? Why is that going to happen? Well, you have a bunch of turbochargers this time we didn't have last time. During the 90s, the big pushes for the market were the new internet, cheap PCs, and cheap software. This time, technology is hyper accelerating on all fronts simultaneously. The development of functional quantum computers means that computational ability is about to increase a trillion-fold at no cost. And the machine that's going to do that is a quantum computer. This is one right here on the right. The world's major computational challenges will be solved shortly, such as weather forecasting and cancer cures. By the way, a few people are going to figure out how to use this in the stock market too. All major human diseases will be cured within the next 10 years. live another decade, and you will have a shot at living to 150 years old. I plan on being one of those guys. Needless to say, tech and biotech stocks will dominate in this scenario and will account for the bulk of stock market gains in our lifetimes. 90s had cheaper computers, cheaper operating, cheaper software. 2020s will have 10 times this number of technology drivers. So who will show you how to play the next 95,000 Dow points? Sit with me, John Thomas, the Mad Hedge Fund Trader, in my Global Trading Dispatch. Discover how you can tap into the top performing trade mentoring service in the industry, and we are up 32.9% in volatile markets. Let a Marine combat pilot steer you to big profits. We trade single stocks and options for stocks, bonds, equities, foreign currency, precious metals, and real estate. This is a typical trading month for us. Do about 10 trades a month. We did 10 out of 11 trades, made money. You can see here we bought the S&P 500, sold short the U.S. Treasuries, bought the Russell 2000, bought Amazon, bought Apple, sold short Biogen. We were sold Biogen. We got stopped out very quickly there. Then bought Palo Alto Networks, sold the yen, sold U.S. Treasuries, bought the SPYs, bought gold. With the China trade war eventually to end, it's just a matter of time before technology stocks break out to new all-time highs. Watch this space melt up going into the end of 2019. Get ready to start wheeling in those whoppers with Global Trading Dispatch as your guide. And yes, that is a 24-inch trout, which I caught in northern Nevada at Lake Pyramid. Here's how it works. We spotted a trading opportunity with Micron Technology when it was trading at the low end of its recent range. We sent out a trade alert that says buy Micron Technology at 42.01 or best, opening trade, and for $10,000 exposure, you buy 238 shares. What happened? The stock took off like a rocket, like we expected. We made a 15.63% profit in 15 trading days. So we sent out another trade alert that said take profits. And that's what this looks like. And this shows that we made a $1,563 profit in 15 trading days. These are some of our big winners in recent years. NVIDIA, we recommended at $68, got a gain of 267%. Lam Research, we made 77% in 10 months. Baidu, we made 2,240% in 10 years. With my Global Trading Dispatch service, you get a daily research newsletter, instant trade alerts sent out at market sweet spots, about 200 a year, and all the reasons why you should be executing them, live bi-weekly strategy webinars with an interactive Q&A, special reports on urgent investment topics, invitations to strategy luncheons around the world, and I'm just about to take a trip around the world where we will have 12 of these. More educational videos and webinars than you consume in a lifetime, access to a 12-year database on investment ideas, searchable by name and ticker symbol. I'll even tell you how to find a good surfing school in North Africa. Warning, it's harder than it looks. Here's what I'm not going to charge you for this service. I'm not going to charge you $100,000 a year. That's what I charge my big hedge fund clients, and they're happy to pay because I make them millions of dollars. And I'm not going to charge you $10,000. That's what I charge my concierge clients who get my personal cell phone number so I can act as their investment 911. And I'm not going to charge you $5,000. That's what I charge my advanced options trading clients. And I'm not going to charge you $3,000. That is what the cheapest price on my website today and the lowest I've ever offered. This is the real deal. Creating this product cost me millions of dollars. With the best customer service in the industry running it cost me millions more. Here's the offer you can't refuse. 1 year for just $1,997.
Just click the Buy Now button on the right.
That will take you to a link to a dedicated sales page, which is only obtainable through this webinar today, right now. This is a limited time offer. I take only 25 new subscribers at a time, so it's first come, first serve. I can't wait to make you a top drawer trader. Just click on the chat box on the right. Let me make the money for you to pay for your own subscription. You make the trades, discover how an experienced hedge fund manager finds and exploits the best sweet spots in any market.
Just click the Buy Now button on the right.
90% of our subscribers make the money to pay for their annual subscription on their first trade. So here it is again, $19.97 for 1 year. And I see a bunch of questions that come in the question box. Let me address those, and I'll just scroll through these testimonials quickly. Bill in Portland, Oregon wants to know if he can talk to me directly. The answer is yes. I spend part of every day calling readers looking for ways to improve the service. You can email me anytime, and I always answer the same day. You can get a chat box for my bi-weekly strategy webinars like this one. Jim in Dallas, Texas wants to know, are the trade alerts for stocks, ETFs, or options? Jim, it's all of the above. We send out a range of possible securities with every trade alert so readers can tailor it to their specific needs and risk profile. Joe in Detroit, Michigan is asking, I've never done this before. Can a beginner start with no prior experience? And the answer, Joe, is yes. Bringing beginners into the market for the first time is one of the primary goals of this service. Joel in New York City is asking, how often is the newsletter sent out? Joel, it's every day the market is open. That's about 250 times a day, and we have 2, 3, or 4 research pieces in every newsletter. Mary in Kansas City wants to know, how many trade alerts do you send out in a year? Mary, it's about 200, depending on what the market is doing. Sometimes we have long quiet periods, other times we'll do 5 or 10 trades a day, just totally driven by the market. Let's see, Roger in Houston, Texas is asking, is the strong dollar over? And I would say, Roger, yes, with the US reducing interest rates faster than anywhere else in the world, that is cutting the knees out from the dollar and creates a nice shorting opportunity for the dollar, long opportunities for the euro and the yen. Here's a funny question. Why are you doing this? You obviously have enough money. Well, my answer to that is teaching people how to make money and secure their financial future is the love of my life. When I was on Wall Street, I used to see so many people get ripped off by brokers, it made me sick. This is the chance for me to level the playing field for the regular guy, and I love doing it. George in Austin, Texas wants to know here, when does your letter come out every day? George, it'll be in your inbox well before the market opening every day, so you can enter trades into your own trading system. Okay, here's one. Ivan in Portland, Oregon is asking, how would you describe your trading philosophy? Ivan, I use fundamentals for my long-term call and technicals for my short-term execution. This is what every long-term professional does. By the way, that's me at Lake Tahoe in the winter. I usually snowshoe all the way around it every winter. That's a trip of about 160 miles. Another question here, do you offer training with a subscription? Roger, we include more training than you can use in a lifetime with books, training courses, and so on. Every trade alert that goes out includes a link to a video on how to execute it on your own online trading platform. We have been writing and creating educational content and videos and so on now for 12 years. We have a ton of stuff that you can use. If you subscribe today, you can also get a copy of my best-selling book, stocks to buy for the coming roaring 20s, sectors and stocks that will lead the market for the next 20 years. Caution, some of them have already doubled, so buy them before they double again. You want to get in early on the big trends of the next decade. And if you subscribe today, I will send out a trade alert instantly with an extremely high probability of success that you can execute immediately and make some of the most serious money of your life. Don't leave good money on the table. 90% of these trades make money right out of the gate. And to tease you a little bit further, here's the chart for our mystery trade alert. Some of you who are in the market daily may guess what this is. I'm not telling, you have to subscribe to find out. Suffice to say, I checked the pricing right before the webinar, and you can execute at tomorrow morning's opening if you want to get in.
Just click the Buy Now button on the right.
That is the only chance you have to take advantage of this price. We don't offer it anywhere on our website. Okay, I'm just scrolling through the questions here, and let me see what we got. Will falling interest rates be bad news for the banks? John is asking, and the answer is yes. It reduces the spread they can make on their loans, and this is a major reason why I've been avoiding banks for several years now. And in fact, our last play in the banks was shorting them. We shorted Bank of America at $50 going into the crash in 08 and rode all the way down to $5. We caught the bounce. I remember an overnight weekend trade. We bought it at $5 and sold it at 10 on a Monday. So yeah, avoid banks. Don't ever confuse gone down a lot with cheap. Cynthia's asking, will silver outpace gold? The answer is yes. Silver typically outperforms gold by 1.5 to 2.5 times on the upside. It is the high beta play in the precious metals market. The pros usually prefer silver over gold. Just be careful. It's also hugely volatile compared to gold. Chris is asking again, said his line cut off for a second. How many trades per day and for what typical average duration should we place? We typically do 200 a year. That can be 0 for a couple of weeks to 5 to 10 a day, depending on market volatility. A typical holding period is a month or less. If stocks often work immediately, and they often do that, we will take a profit in a couple of days, and every year we get same day 100% profits. So we get a couple of those a year. We don't get them with every trade like some of the other services promise. Okay, Jill just signed up, and Jill, thank you, and look forward to working with you. And you have any questions, just shoot me an email and I'll get back to it as quickly as my fingers can type. Okay, we have Bill here from Fresno. He also just subscribed, says, thank you very much. Can't wait to get started. Thank you for your service. Okay, I don't see any more questions here, so I'm just going to leave this open for a while so you can access the dedicated sales page and get that special price one time only. Thank you for coming today. This is John Thomas, the Mad Hedge Fund Trader, signing off for today. Good luck and good trading.